When you think Rolls-Royce, maybe luxury cars come to mind, or those huge jet engines.
Not a little classic images.
Exactly. But their latest half-year results, well, they reveal something really quite fascinating. This industrial giant. It's reinventing itself.
In some pretty fundamental ways.
Yeah, ways you might not expect. So today, we're going to dive deep into how they're, pulling off this incredible transformation.
Sounds good.
Okay, so our mission today, it's really to sift through these, the detailed 2025 half-year results from Rolls-Royce Holdings PLC.
Right. Get under the hood a bit.
Yeah, and we're not just like looking at the raw numbers, are we? We want to uncover the surprising strategic moves, the bold future outlook.
And how they're actually navigating the tough stuff.
Exactly. Things like supply chain disruptions, tariffs, all that, while posting, frankly, pretty impressive growth.
And making big moves into new areas, too, like sustainable tech.
Right. So you, listening, should walk away with a much clearer picture of, what makes this company tick right now.
And it's important to maybe stress, this isn't just about small adjustments. It's not incremental tweaks we're seeing here. No, these results, they really lay bare a comprehensive multi-year transformation. It's fundamentally reshaping the business model.
Reshaping it how?
Well, we're talking about shifts designed to build a Rolls-Royce that's, well, far more resilient and, crucially, more profitable for the long term.
Okay. All right. Let's peel back the layers then. Start with the big picture. What does their first half performance for 2025 tell us? They're calling it a strong first half performance.
No, they absolutely are. And yeah, for good reason. Look at the underlying operating profit.
Okay.
It soared by 50%, to $1.7 billion.
Wow.
And that comes with a really robust 19.1% margin.
Nearly 20%. That's healthy.
It is. Think almost 20 pence profit for every pound of revenue.
Yeah.
And free cash flow saw a healthy jump too, $1.6 billion.
Okay.
Now, what's truly remarkable here, I think, is that they pulled this off despite those headwinds we mentioned. Ongoing supply chain issues, tariffs.
They're still dealing with that.
Oh, yeah. But despite that, these strong figures, they've actually given them the confidence to raise their full-year guidance for 2025.
Oh, really? What are they projecting now?
They're now expecting between $3.1 billion and $3.2 billion in underlying operating profit and $3.0 to $3.1 billion in free cash flow.
That certainly sounds like a company feeling pretty confident. Their CEO, Tufan Erginbilgic, he put it quite plainly.
What does he say?
He said, "Our multi-year transformation continues to deliver. Our actions led to strong first half-year results despite the challenges of the supply chain and tariffs. We are continuing to expand the earnings and cash potential of Rolls-Royce."
Captures it well, confidence backed by numbers.
But I'm curious, though, you mentioned those persistent supply chain issues.
Yeah.
Even with these strong numbers, how much of this is, truly sustainable? Are they still navigating some significant headwinds under the surface?
That's a really good question. And yeah, the report does touch on it. The confidence, it seems rooted in real operational improvement.
Okay, like what?
Well, for instance, their net cash balance. It's now at a pretty solid $1.1 billion.
Right.
And their cost efficiency, it seems to be hitting a new level. We see this in something called their TCCGM ratio.
TCCGM. What's that based on?
Basically how much cash it costs them to generate each pound of gross profit. Think costs of goods sold, but broader.
That efficiency metric.
Exactly, and it's dropped significantly. It's down to what they call best-in-class, 0.35x. Last year, first half, it was 0.49x.
Oh, quite an improvement.
Huge improvement. It's like they're really fine-tuning the machine, getting incredibly efficient at turning operations into profit, squeezing more bang for their buck.
So proof they're managing those headwinds better.
It certainly suggests that. While supply chains are still a challenge, absolutely, they seem to be managing them with far greater efficiency now.
And for anyone keeping an eye on, investor returns.
Ah, yes. Well, they announced an interim dividend, 4.5 pence per share. That's set to be paid out in September. And on top of that, the share buyback program, they planned £1 billion for 2025.
Yeah.
They've already completed 0.4 billion of that. So 400 million back already.
Okay, so it feels like they're solidifying their financial base, but also rewarding shareholders at the same time.
That seems to be the balance they're striking, yeah.
Right. Now that we've got the big financial picture, let's zoom in a bit.
Okay.
Because to really understand this transformation, I think we need to see how each of Rolls-Royce's main divisions, civil aerospace, defense, power systems, how they're not just growing, but maybe fundamentally reshaping their roles.
Absolutely. And you see it clearly in civil aerospace. The change there is profound.
How so?
Well, first, the margin improvement we talked about jumping to 24.9%. That's up from 18.0% same time last year.
Big jump.
It is. Underlying operating profit hit $1.2 billion. That's a massive 63% increase.
Wow. But what's the insight there, beyond just better numbers?
The real insight is how they're transforming the business model itself. Look at their time on wing program.
Right, keeping engines flying longer.
Exactly. They're aiming for over 80% improvement across the modern Trent engines by 2027. And specific things like the Trent 1010's new turbine blade.
Yep.
They say it will more than double its time on wing.
Double it.
Double it. Now, this isn't just about making better engines. It's about reliability, fuel efficiency that builds deep, long-term relationships with airlines.
Ah, securing the service contract.
Precisely. Decades worth of lucrative service contracts. It's a fundamental shift, really, from just selling engines to selling engine uptime, availability, reliability.
That sounds like a much more resilient business model.
It absolutely is. And the order book backs this up. Large engine orders increased by 12%, up to 2,056 engines on the books.
And new orders coming in.
Yeah, 349 orders just in the first half of 2025. And engine flying hours, EFH, they've reached 109% of 2019 levels.
So fully recovered and growing past pre-pandemic levels.
Seems so. Strong recovery and growth in their core market.
That's a huge shift, that move from product sale
Yeah.
to long-term service partnership. How does that actually translate for the airlines themselves? Does it mean like more predictability for them, lower costs?
Precisely. For the airlines, yeah, it translates directly into greater operational efficiency, lower maintenance costs over the engine's life.
Makes sense.
I mean, when an engine spends more time on the wing, less time in the shop, that's money saved, more flights completed, it becomes a win-win. Deepens that relationship.
Got it. Okay, what about defense?
Right, defense. It delivered a pretty stable operating profit, $342 million won. That maintained a 15.4% margin.
Stable despite headwinds.
Well, they noted some minor supply chain impacts, particularly in the naval side of things, but overall, demand remains incredibly high.
High demand. How high?
They secured a really strong order intake, $4.0 billion just in the first half. That gives them a book-to-bill ratio of 1.8x.
So orders coming in almost twice as fast as revenue going out.
Essentially, yeah. And the total order backlog is now $18.8 billion.
$18.8 billion.
Yep. To put that in perspective, that's roughly 4 years of revenue already secured.
4 years. Wow, that's remarkable stability for defense. What do you think is driving that sustained high demand?
Well, it's a mix of factors, I think, but fundamentally it comes down to, national security concerns globally.
Yeah.
The ongoing need for really robust, high-performance engines, military aircraft, naval vessels.
Yeah.
Rolls-Royce has such a deep, entrenched position here, and these big, long-term contracts demonstrate how critical their tech is. Things like the $1.5 billion support contract for the UK's Typhoon jets.
Right.
And a $1.0 billion sustainment contract with the U.S. Air Force for their C-130J engines, the AE2100s.
So it's very sticky business, essentially.
Very sticky, critical to sovereign capability.
And the third leg, power systems.
Right, power systems. Here we see significantly improved operating profit. That's their term.
How significant?
Up 89% to $313 million.
Huge jump.
Massive. And the margin went from 10.3% last year to 15.3% now.
Okay, what's driving that growth?
It's primarily driven by, absolutely, it's a key part of the strategy.
That rapid growth in data centers, though, it's a fascinating pivot for a company like Rolls-Royce. Are they facing, really intense competition there? Or does their legacy, their engineering background, give them an edge?
Oh, the market for data center power is definitely competitive, no doubt. But Rolls-Royce brings, that long history of reliability, robust engineering.
Which is critical for data centers.
Absolutely paramount. They need 247 uptime. Plus, Rolls-Royce has that established global service network. That's a significant advantage.
Right, it's not just selling the box.
Exactly. It's providing the whole reliable power solution. Service, maintenance, uptime.
Okay, so it's clear these results aren't just, numbers on a page. They seem to be a direct reflection of Rolls-Royce's 4 strategic pillars they talk about.
Driving the whole transformation.
But, for a company as massive, and let's face it, pretty traditional as Rolls-Royce, how challenging is it really to drive these kinds of ambitious changes across such different divisions?
That's a really crucial point. It's an immense undertaking, no question.
Are there hints in the report of, internal hurdles they're still facing? maybe potential missteps?
The report focuses mainly on the progress, understandably, but you can infer the scale of the challenge. However, it does show tangible progress on each pillar.
Okay, let's maybe walk through those pillars, starting with portfolio choices and partnerships.
Right. The Rolls-Royce SMR initiative, small modular reactors, that's a real standout here.
Mini nuclear reactors.
Basically, yeah. They've been chosen as the sole provider for the UK's very first SMR program.
Sole provider. That's big.
It is. It involves 3 units initially, expected to connect to the grid by the mid-2030s. And this isn't just some, long-term R&D project anymore.
No.
No, they anticipate it starting to generate revenue and profit from late 2025 onwards.
That soon?
Apparently. And they expect it to be profitable and free cash flow positive by 2030.
Wow. That's a huge future revenue stream then, and a major play in the energy transition.
Absolutely. And it's not just the UK. There's been a strategic investment from EEZ Group, the Czech utility.
Yeah.
They've committed to buy up to 6 SMRs. And there's significant international interest too, Sweden was mentioned.
So real momentum behind the SMRs. What else under partnerships?
Another key partnership, a new MRO facility. Maintenance, repair, and overhaul.
Right, for the jet engines.
Exactly. It's with Turkish Technique at Istanbul Airport, set to be operational by the end of 2027. That directly addresses that growing aftermarket demand we talked about.
Bolstering the service revenue stream again.
Precisely. It all ties together. Plus investments in next-gen engines for power systems and upgrades for military engines.
Right.
Oh, and they also divested some non-core naval businesses.
Okay, tidying up the portfolio. What about the second pillar? Efficiency and simplification.
Right. We already touched on that impressive TCC-GM ratio 0.35x.
Yeah.
Well, they've delivered over $450 million in these efficiency and simplification benefits since 2022.
$450 million?
Yep. And they're on track to exceed $500 million by the end of this year, 2025.
And this isn't just like cutting costs for the sake of it.
Yo, it's strategic. These savings are crucial for offsetting those inflationary pressures. And it frees up capital. Money they can then invest in those growth areas, SMRs, data centers, BESS, engine tech.
Got it.
They've also achieved over $850 million in gross third-party cost savings since 2022, aiming for over $1 billion by year-end.
Wow. How are they achieving these savings?
Part of it is expanding their group business services, or GBS, centralizing support functions.
Yeah.
They opened a new center in Poland, expanded one in India, greater efficiency through scale and standardization.
Makes sense. Okay, third pillar, lower carbon and digitally enabled businesses.
Yeah, and the SMR and BESS developments we mentioned are obviously prime examples of driving lower carbon solutions.
Right.
On the digital front, they're increasingly adopting AI, artificial intelligence, across the group.
How are they using AI?
Well, they're testing a generative AI platform, think ChatGPT-style tech, for things like accelerating new product introductions, making MRO processes more efficient. They're also using digital tools, data, and AI for better supply chain transparency, getting that real-time view of where everything is, which helps manage disruption.
Okay.
And a really significant move, migrating their engine health monitoring EHM to the cloud.
EHM, that's the system that watches the engines in flight.
Exactly. For their key wide-body and business aviation engines, moving it to the cloud improves performance, scalability, resilience, and critically, it enhances their advanced AI capabilities, predictive maintenance, performance improvements. Think of it like putting a super smart doctor inside every engine, constantly monitoring its health.
That AI integration, especially in EHM, that sounds like a potential game changer.
Yeah.
It's fascinating how a company so rooted in, heavy machinery is embracing this cutting-edge digital tech.
It really is. It's becoming integral to the offering.
So, okay, what does all this actually mean for the future? Let's look ahead. Rest of 2025, those midterm targets for 2028.
Well, as we said, the full year 2025 guidance got that nice bump up. Underlying operating profit, 3.1 to 3.2 billion pound. Free cash flow, 3.0 to 3.1 billion.
Right.
However, they do flag maybe a slightly lower delivery in the second half of 2025 compared to the first half.
Oh, that a sign of trouble?
Doesn't seem like it. They attribute it to a few things, like lower benefit from certain contractual margin improvements compared to H1.
Yeah.
Also, more original equipment deliveries, which tend to have lower initial margins.
Okay.
And also, higher investment in civil aerospace MRO. More major shop visits, particularly for those Trent 1000 engines.
So investing in that long-term service value again.
Exactly. It's consistent with the strategy.
Okay. And looking further out to 2028.
Right. The midterm targets. They are definitely ambitious, clearly aiming for continued strong growth.
What are the numbers?
Underlying operating profit. Target is $3.6 billion to $3.9 billion.
Okay.
Underlying operating margin, 15% to 17%. Free cash flow, aiming for $4.2 billion to $4.5 billion.
Wow. Big numbers.
They are. And return on capital.
Right.
18% to 21%. They've also put out specific margin targets for the divisions by then.
Which are?
Civil aerospace, 18-20%. Defense, 14-16%. And power systems, also 14-16%.
And the CEO, he reinforces this,
Right.
saying the targets are a milestone, not the destination.
Yeah, he said, we see these targets as a milestone, not a destination, with substantial growth prospects beyond the midterm, really emphasizing that long-term growth ambition.
So what really needs to go right for them to hit those pretty ambitious 2028 targets, especially given those persistent challenges like supply chains?
Yeah, it really comes down to sustained execution across all those strategic pillars we just talked about.
Right.
They need to keep driving those efficiencies. They need to successfully scale up SMRs and BS, continue to innovate in engines and services.
Big challenges.
Well, it's important to note, yeah, despite the positive momentum, they still anticipate those challenges. Supply chain issues, for example. Yes, they expect those to impact cash flow by $150 to $200 million for the full year 2025. And they project those issues will persist through 2026.
Okay, so not gone yet.
Not gone yet. But the report stresses their proactive actions are helping to mitigate the impact. They're essentially trying to build resilience into their operations to handle it better.
Okay, let's circle back quickly to their financial position. All this transformation, these investments, what does it mean for the company's stability, financial resilience?
It signifies a substantial strengthening and immense flexibility, actually.
How so?
Well, that net cash position increased to $1.1 billion. That's cash on hand after accounting for debt.
Right.
And they boast a really robust overall liquidity position of $8.5 billion.
$8.5 billion, what does that include?
That includes $6.0 billion in actual cash and equivalents, plus $2.5 billion in undrawn credit facilities, like available credit lines.
So think of that $1.1 billion net cash as their buffer, their growth fund.
Exactly. It means they're not just surviving day to day. They have the financial muscle to invest in those big SMR projects, data center capacity, R&D, and also weather unexpected storms. Gives them incredible stability.
And helps manage debt.
Absolutely. This strong position lets them manage debt obligations effectively. For instance, there's a $1.0 billion bond maturing in October 2025.
Yeah.
They plan to repay that directly from free cash flow. No need for refinancing. Same for other maturities coming up in 2026.
That's a strong signal.
It is. And one other point on financials, they reported a net reduction in provisions by $377 million.
Provisions. What are those exactly? Money set aside for problems.
Basically, yeah. Money set aside for future liabilities or expected losses. So a reduction is good news.
Why do they reduce them?
Partly, they said, due to successfully renegotiating some onerous contracts.
Onerous contracts.
Yeah.
Sounds bad.
They can be. These are typically long-term agreements where maybe due to inflation or changing circumstances, the cost of actually fulfilling their side of the deal has become higher than the revenue they'll get from it.
Ah, so getting out of those is like removing a financial drag.
Exactly, removing a drag from the balance sheet. And of course, as we mentioned, they're continuing to return value to shareholders, that interim dividend, the ongoing share buyback.
Okay. This all sounds very positive, very structured. But it raises an important question for me. How does a company of this sheer scale truly sustain this kind of momentum, especially when you're facing, constant external risks in a volatile global environment? How do they plan to keep this train on the tracks?
Yeah, that's key, isn't it? Sustaining it. They do it through what they describe as a comprehensive risk management framework.
Okay, not just a checklist.
Doesn't sound like it.
Yeah.
It seems deeply integrated into their strategy. They categorize risks into these pillars, things like safety, compliance, strategy, execution, business interruption. Standard stuff, maybe?
Right.
But then they identify specific drivers which could exacerbate these risks. Things like the energy transition itself, cyber threats, market or financial shocks, political instability.
Talent gaps, technology shifts.
Exactly. Talent and capability, technology. By structuring it this way, it allows them, theoretically, to address potential issues much more proactively, rather than just reacting when something goes wrong.
Makes sense. Do they mention specific risks Like climate change?
They do. They say climate change implications are considered in their financial estimates. However, they state they don't expect it to have a significant impact on their going concern assessment in the near term.
Meaning they believe they're well prepared to handle those challenges for the foreseeable future.
That seems to be the assessment, yes. Prepared and resilient.
Wow. Okay, what a deep dive that was. I've really seen Rolls-Royce's, well, incredible transformation journey, haven't we? Moving from, sharpening up operations, fundamentally rethinking the business model in some areas.
Yeah, like civil aerospace services.
Right. All the way to making these really bold strategic moves into new energy, digital tech.
SMRs, BESS, AI.
Yeah. It's clearly far more than just financial numbers we've been talking about. It really feels like a story of profound reinvention.
It does. And maybe as you, the listener, think about what we've discussed today. Consider this. How is a company like Rolls-Royce, with such a deep legacy in, traditional heavy industry, how are they actively redefining what an industrial giant even means in the 21st century? Blending that core mechanical prowess with cutting-edge digital innovation and a real commitment now to lower carbon solutions. What might that signify, perhaps, for other established industries that might be looking to navigate a similar path of reinvention?
That is a truly thought-provoking question for all of us. Well, thank you so much for joining us on this deep dive today. We hope you found it insightful. We definitely encourage you to keep exploring these fascinating topics on your own.